In terms of sectors, as I said, banking and financial is doing well. So PSU Bank Index, that's the top sectoral mover. IT is also doing fairly well for itself, 0.4% kind of gains. TCS was trading in the red, HCL Tech was flat, but other IT names were kind of buzzing, which is what is keeping the IT sector afloat. Metals doing well. Dollar index, of course, has cooled off, and that's aiding sentiment for metal stocks. On the downside, however, real estate, there's no solace for this particular index. Real estate index had severely underperformed in 2025 and it continues in 2026 as well. Pharma, autos, FMCG are some of the other sectors that are on the back foot. But the good part is that, yes, I know the one day up move that we saw kind of fizzled out, but yesterday's swing low was 25,473. Thankfully, we are still far away from that level. So not sure whether one should really worry or panic so much. But a lot of this volatility that we saw today is attributable to the fact that it is weekly expiry day. But of course, to understand where things are headed from here and what one should be doing in this leg of volatility, extreme volatility that we are witnessing on the Lal Street, let me bring on board Sandip Agarwal, who's the fund manager at Sowilo Investment Managers. Sandeep, lovely chatting with you this afternoon. Yesterday, of course, the sentiment turned around because of commentary coming in from Sergio Gore, in terms of how he plans to take things forward when it comes to the India-US relationship. That really triggered the bulls, and we saw a very, very solid comeback in the market. But there were questions as to whether or not it will sustain, and that's exactly what that's something that has really not happened. Would you attribute today's volatility to F&O expiry, or would you say that the kind of bounce we saw yesterday was short-lived, and we need to see more concrete details when it comes to trade deals to actually say that the sentiment has turned around?
Hey, hi, good afternoon, and thanks for having me on the show. So I will just highlight few things, right? So we have to remember that the large part of the impact which was there because of initial tariff hike for many companies which has exposure to the US. A lot of that has come into numbers, and even if they would not have come in numbers, the commentary or the update from management has led to analysts making those adjustments in the numbers, and because of that, huge cuts have already happened, and that is the reason you will see a lot of micro caps, small caps, and mid caps have corrected a lot. Although at index level, mid cap index may not look very low. So that is one. So large part of the cuts have happened, and this kind of moves when happen. What we are seeing in last few days is that now it is a place where I think there is a buyer in even mid cap and small cap at regular interval, and because of that, whatever goes down sharply, it is being absorbed. So I think this is a typical consolidation phase of a bear market in the small or micro cap which we are witnessing. And I think fundamentally the companies which are good, which deliver good numbers, good management, good quality products to offer, I think they will all recover very quickly and very fast as some clarity on the tariff comes or some relief in budget comes. So I think people are looking forward to that. Also remember, Indian investors have matured over time. They have seen so many cycles, so they are very clear that whenever the time is appropriate, whenever there is a deep correction, they will definitely go ahead and buy what they want to buy. And I think that is what is playing out. Also, incrementally, we hear a lot of seasoned fund managers and CIOs now coming on channels and saying that small cap and mid cap have entered their comfort zone to buy versus what it was a year back when they were extraordinarily expensive. I think all those things have started playing together, and I think Indian market has long way to go because we are at almost bottom of the cycle in terms of FI selling. Lot of selling has happened. I don't know. I can't say that they will not sell more, but I think a large part of selling has been done. Our economy is doing quite well. The inflation rates are contained. RBI has a lot of scope to cut rates. So all the positive things which we can think of, I think they are coming, and people are pricing all those things also at the same time when they are pricing in a depreciating rupee in the current environment.
Okay, so you concur with the fact that when allocating fresh money, one should look at broader markets, because you said that mid and small caps, that's the hope that mid and small caps will do better this year.
So if you see fundamentally, the growth rate in mid and small cap has been higher than large cap, even last few quarters also, and I think
Hmm.
that trend will continue. Only thing is that in large cap, what happens, your margin of safety, or the it is a hiding place and more liquid, so you can get off your big positions and all those things. So that is the advantage. But and that is the reason a lot of money gets allocated there. While in mid and small cap, because of the size of the market cap, there is a liquidity issue to buy also, and there is a liquidity issue to sell also, and we face that challenge in mid and small caps, and that challenge cannot be ruled out even further. So you will see very choppy mid and small cap movements in next few months also. But I believe that fundamentally mid and small cap, because of the base at which they are operating, they will definitely deliver better growth than large cap. And now they are they have started looking better in peg ratios than large cap. Let me put it that way. And for us, peg ratio is much more important than the PE ratios.
Hmm. Okay, PEG ratio much more important than the P ratio. Before I talk about the structural themes to look at, want to understand your verdict on the numbers that have come out from the IT stable. TCS, HCL Tech, of course, steady quarter. HCL Tech more so, given the fact that it has managed to beat expectations in terms of margins and revenue, and of course, it has also upgraded its guidance. uh, for TCS, of course, we've seen that one-time hit on bottom line as a result of the labor code. Uh, the street view is fairly cautious, but I was just going through Macquarie report. They are pretty upbeat on TCS. Their price target indicates almost a 50% upside from current levels. After the kind of up move we've seen in IT since last quarter, in the matter of a quarter, we've seen a good rally coming in IT, right? So, post that, do you see a headroom for upside right now, or would you say that a couple of more quarters would be needed, or would need to unfold before we see more upside from here? What is your sense?
So, every stock, how it will perform is a factor of two things: the earnings growth and the multiple one will like to assign. So, very tough to give a call on multiple, because different fund managers have different kind of perspective view, and global economy and global macros and Indian macros, everything plays a role, including currency into that. So, very tough to give that call. But let me give you a perspective that the penetration level of Indian IT in the largest market in US in the sourcing side is very high. Even within the global sourcing, if you take pure IT services, we will be more than 90% market share, and if you include BPO, will be 70-75%. So it is a very big number which we are already there. So the chances of growth from here is very low for the sector as a whole. Secondly, the almost 8 or 10 years, or more than 10 years, we have seen substantial growth in the services revenue at global IT spends, and it went up substantially during the digital times. But last 1.5-2 years, since AI has come, the hardware, after 10-12 years of decline, it has taken a front seat, and it has started growing in last 1.5-2 years, and that is the reason you see the big moves in the Nvidias and other stocks. I believe that once this hardware replacement cycle is over, you will see some spend again coming back in the software side, and that is the time probably when you will see that all the companies benefit. But remember that there are two challenges to the Indian IT at a macro level. One, the market is highly penetrated. We have the lion's share of in the global sourcing market, and that industry, even if it comes back post hardware replacement, the growth will be minuscule, 2-3% at global level, and maybe India level 6-7%, and this company can do 7-8%, let's say hypothetically. Second is that large caps also have a double whammy from the fact that earlier, till before COVID, the deal, who can participate in which deal, was decided by the balance sheet size and the past execution track record of the size of the order book they have executed. Now those conditions have been completely taken away. So the biggest challenge large cap Indian IT companies are facing is that from 3-4 vendors in a deal, now there are 15-20 vendors in every deal, because the size of the companies are no more important in any deal. And that is the reason that even the small companies are competing with the largest company in the sector whenever a new deal is coming. So I think this challenge is real and very tough to get over. So I would put it this way, that I think that the large cap Indian IT is a sector at best 5-6% growth for long term, and the mid cap can be 10-11% growth, and the small cap could be 14-15% growth. And in terms of multiple, the peg ratios are highest in mid cap, followed by large cap, and then small cap. So I think now time has come where what you saw in mid cap between 2021 to 24, the way they went up 10-12x in very short span of time, maybe small cap can, I will not say 10x, but they can do better, much better in terms of return. followed by, some returns in mid cap and very low return in the large cap. It is a very, very matured industry.
Okay, point taken. But let's also talk about platform companies, right? Especially the quick commerce ones. Sources say that Labour Minister has nudged companies to discontinue branding of 10-minute delivery to protect the gig workers, right? Now, meetings were held with leading platforms, including the likes of Blinkit, Zepto, Zomato, Swiggy, etc. Quick commerce companies haven't really reacted yet. But what would this really mean? Because if the 10-minute branding goes, do they not lose their edge? And of course this will also impact their profitability, right? So if this really happens to remove the 10-minute branding, what would this really mean? And how do you see this development if at all it happens?
No, so I think that, whether 10-minute branding stays or goes, it will have a temporary impact. See, what has happened is this companies, these platforms have changed the way people are living their life, and that impact cannot be taken away by changing the branding. So today, if you want something, means we are seeing in our daily life at morning 6, if I want something, we do Blinkit, Insta, and we get the things. So I think that cannot be taken away by just changing the branding. So I think these platforms are doing an excellent job. All this noise around this, some impact will be there, some cost increase can be there, but this is the way the human lives have changed. You will be surprised to know that more than 8 to 10 million people have got employed on through platforms in various businesses in the country in last few years. So it is a very big population which is employed. And obviously, when you grow to such a scale, we have seen that in IT services software side in late 90s, that you have to bring a lot of changes to the system process and everything. I think those things will come. The insurance, what they are asking, security, and all those things, there will be some cost impact. I think the habit which already people have, they won't mind paying 2 rupees extra for delivery or 5 rupees extra, and that is all we are talking about in change of cost. So yes, in near term might look difficult and all that, but in long run, I don't think this makes any dent to the structural theme or structural thesis of the platform businesses.
Okay, all right, point taken. And lastly, which are the structural growth themes that could shape the next phase of wealth creation according to you? Where would you look at when you spot themes right now?
So we are very clear that we will have to be very aggressively into the capital markets theme, because we believe that the penetration of capital markets is still very low, and you compare the AUMs of international of other countries like US and all, and with Indian AMCs, there is a huge difference. So we have a long way to go. Equity penetration is very low. So we want to be very aggressively, and we have been consistently investing in the capital market thing for quite some time. And second is manufacturing. We believe that we have a challenge for last few quarters in the private investment side and private capex side, and that is the reason the manufacturing stocks have made a big negative return. But over a long term, I think for us, growth will come in manufacturing. There is a lot of focus of everyone towards that. So we are very, very aggressively focused on manufacturing. We are focused on capital markets. We are focused also in banking side, because we believe the NPA cycle, which is there currently, is one of the best cycle. There is virtually not much credit cost. It is very good. So and credit growth is also going to pick up with private capex coming in. So these are few themes which we love a lot. Although we do see we also like the pharma theme, but we are little away from the CDMO now, because it has gone very expensive. So we have got out of the CDMO theme. Now we have gone back to the generics theme, where the stocks are very, very reasonably priced. And we are right now not preferring any FMCG or CDMO thing or IT. Though we have also some small exposure to the platforms, because we love those businesses.
Okay, all right. Taking your point, all those sectors that you mentioned on your radar. But with that, Sandeep would like to thank you for taking our time and joining in. Look forward to a longer conversation pretty soon. I had a whole lot of questions that I wanted to ask, but I'll save it for next time. Thank you for joining in this afternoon.
Thank you.
Thanks a lot. All right, let's shift focus to the market then.